For retirees, investing is no longer about chasing high returns. It's about protecting what you've built. But one silent enemy often gets ignored: inflation. It quietly eats away at purchasing power, reducing the real value of your savings year after year. Many retirees believe that once they stop working, they can rely on fixed income and cash reserves, but that's a dangerous illusion. Inflation doesn't retire when you do. Let's uncover how ignoring it can harm your future and how to build a portfolio that keeps your money working, even after you stop. 10. The erosion of purchasing power. Inflation is subtle, yet destructive. Every year, the prices of goods, healthcare, and essentials rise. What feels comfortable today may feel tight tomorrow. A retiree living on a fixed income quickly discovers that the same pension or interest payment buys less each year. This erosion isn't sudden, it's gradual, making it easy to ignore. But ignoring it doesn't stop it. Inflation quietly eats away at savings, like rust on steel. The key is awareness. You must plan for rising costs, not just your current needs, to preserve dignity and security in retirement. 9. Fixed income isn't truly fixed. Many retirees flock to fixed income investments for stability, believing that predictable payments equal safety. But that stability can be deceptive. When inflation rises faster than your bond yields or annuity payouts, your real income shrinks. What seemed like enough at age 65 may fall short by age 75. The phrase fixed income shouldn't mean fixed lifestyle. To combat inflation, retirees must blend stable income with assets that can grow: equities, inflation-linked bonds, or real estate. True safety lies not in stillness, but in balance. 8. The illusion of safety in cash holding. Large amounts of cash feels safe, but it's one of the riskiest long-term moves. Cash loses value as prices rise. A retiree keeping too much in savings accounts or CDs may feel secure while actually falling behind. Inflation turns your hard-earned nest egg into a shrinking shadow. Every year, your money quietly buys less. A better strategy is to keep enough cash for short-term needs, but invest the rest in inflation-protected assets. Safety should mean preserving purchasing power, not freezing your finances. 7. The role of equities in retirement stocks may seem too risky for retirees, but they're one of the best defenses against inflation. Over time, equities tend to outpace rising prices, helping portfolios maintain real value. The key is moderation, not abandoning stocks, but holding them wisely. Dividends, blue-chip companies, and balanced funds can offer growth and stability. The fear of volatility often pushes retirees away from stocks, but in doing so, they risk something worse: stagnation. A carefully planned equity allocation keeps your money working, not with reckless risk, but steady resilience. 6. Understanding real returns. Most retirees focus on nominal returns, the percentage they earn on paper, but what truly matters is real return, which accounts for inflation. If your investment yields 4%, but inflation is 3%, your real return is just 1%. That's barely growth. Understanding this difference changes everything. When retirees plan with real returns in mind, they make wiser choices, prioritizing assets that preserve buying power. Ignoring inflation-adjusted performance leads to overconfidence and, over time, an invisible decline in financial comfort. 5. Healthcare inflation. The hidden threat. Inflation doesn't affect all expenses equally. Healthcare costs often rise much faster than general inflation. For retirees, this is a ticking time bomb. Medical bills, insurance premiums, and long-term care expenses can double or triple within a decade. Without planning for healthcare inflation, even a well-built portfolio can crumble. It's crucial to include health-specific growth buffers, such as medical savings accounts or targeted investments, to stay protected. Ignoring this one area can undo decades of saving discipline. 4. Inflation-protected securities. Retirees have a unique ally: inflation-protected investments. Treasury, inflation-protected securities, TIPS, inflation-linked bonds, and certain annuities adjust with price levels. They offer peace of mind. Your returns rise as inflation rises. While they may yield less in calm times, they shine when prices surge. A mix of these in a portfolio ensures that no matter how high inflation climbs, your income retains its strength. It's not about timing the market. It's about engineering resilience. 3. The importance of diversified income streams. Relying on one income source in retirement, whether pension, rental, or dividends, can be risky. Inflation affects each differently. Diversifying income ensures that when one falters, another keeps pace. Combining steady bonds, inflation-adjusted securities, dividend-paying stocks, and modest real estate exposure creates a dynamic shield. The goal isn't to be aggressive, but adaptive. Flexibility is the best inflation hedge. When your income moves in sync with prices, you maintain control of your lifestyle, not inflation. 2. Revisiting your plan. Regularly, retirement isn't static. Inflation, rates, and expenses change constantly. A plan made 5 years ago may not work today. Regular portfolio reviews help retirees stay aligned with current realities. Rebalancing toward inflation-protected assets, trimming underperformers, and adjusting spending habits keep your plan alive. The biggest mistake retirees make is believing their job is done after retiring. The real work protecting your wealth has just begun. Adaptation, not assumption, ensures peace of mind. 1. The cost of forgetting. Inflation. Forgetting inflation is one of retirement's most expensive mistakes. It's not loud or dramatic, it's slow erosion. Retirees who ignore it wake up years later with the same income but higher expenses and shrinking comfort. Inflation isn't just a number, it's a silent tax on your future. The best defense is awareness, planning, and smart diversification. By respecting inflation's power, retirees can protect the life they've earned and continue living on their terms, not inflation's terms. Inflation never stops, and neither should your strategy. Retirement isn't about sitting still, it's about staying smart. If this helped you understand how inflation quietly reshapes your financial future, don't forget to like this video, subscribe for more clear, practical financial insights, and hit the bell icon to stay updated. Keep learning, keep protecting, and keep growing, because even in retirement, your money should keep working for you.